In this video, we'll learn why and how accountants book adjustments for merchandise inventory. In prior videos, we learned how purchases and purchase returns and allowances are recorded under the periodic system. During the accounting period, all purchases of merchandise are debited to the purchases account. Do you recall that no entries are made directly to the merchandise inventory account during the accounting period? Consequently, when the trial balance is prepared at the end of the period, the merchandise inventory account still shows the beginning inventory for the period. So at the end of the period, a business determines the ending balance of the merchandise inventory account. Do you recall that we did that for our supplies as well? At the end of the period, we counted our supply inventory to determine how much had been used up during the period. We'll do the same for our merchandise inventory. This process is called a physical inventory. The first step is doing a physical inventory is determining the ending inventory. We do that by counting the number of units of each type of item on hand. As the merchandise is counted, the quantity on hand is entered on an inventory sheet. The inventory sheet lists the quantity of each type of good a firm has in stock. For each item, the quantity is multiplied by the unit cost to find the totals per item. What unit cost does a business use? There are a few options, and the choice depends often on the industry, product, or storage. LIFO, or last in, last out, or the oldest cost, FIFO, which is first in, first out. But that's for another discussion. The entire process of counting and valuing the inventory might sound easy, but it can be quite complicated. The totals for all items are added to compute the total cost of merchandise inventory. The inventory adjustment is made in two steps using the accounts merchandise inventory and income summary. The first is to debit income summary and credit merchandise inventory to remove the beginning inventory. And second, we debit merchandise inventory and credit income summary to record the year-end inventory. Here are two examples. In the first example, the beginning inventory is $125,000 and the ending inventory is $106,190. To record this entry, we first remove the beginning inventory to income summary by debiting income summary for $125,000 and crediting merchandise inventory for $125,000. Then we debit merchandise inventory for $106,119 and credit income summary for $106,119. The second example is nearly identical except for the amounts. In this case, the beginning inventory for NorCal wholesalers was $123,000 and the inventory at the year end is $104,319. The first step is to remove the beginning inventory to income summary by debiting income summary for $123,000 and crediting merchandise inventory for $123,000. Then we debit merchandise inventory for $104,319 and crediting income summary for $104,319.